Imagine it's some year 1st December 2001. You are a 44-year-old school teacher living in Buenos Aires, Argentina. Your apartment is small but solid, with green shutters that rattle when the buses pass below. For years, the peso has felt as safe as the dollar, so you and your husband keep your savings in the bank. Not under the mattress like your parents once did. Every month, your salary lands in the same account. Every Saturday, you stop at the branch on Avenida Rivadavia to withdraw enough cash for groceries and school shoes. You are not rich, but you have done everything right, like a family laying one careful brick at a time. If you have ever wondered why a government would suddenly stand between you and your own money, stay with me. What you're about to hear is not a theory. It is a pattern seen in rich and poor countries. Subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Then the radio says the word corralito. Cash withdrawals will be limited to 250 pesos a week. The amount sounds harmless, but the meaning lands like a stone. A wall has risen between ownership and access. By Monday, bank lines curl around the block. Argentina is in chaos and the president flees by helicopter. Millions of families learn a brutal lesson. A bank account can be frozen faster than a society can understand. This video is about the United States, Argentina, Cyprus, Greece, and Lebanon. Different flags, same cold moment. History shows the same shape in the shadows. First comes strain, then denial, then the overnight decree. Once you see that pattern clearly, you start seeing the modern world very differently. Before we go further, bank accounts do not usually freeze because money vanished in one night. They freeze because too many people try to turn promises into cash at the same time. A bank is not a steel box. It is a reservoir with many pipes leading out. Your deposit is lent out, invested, or used to fund mortgages, business loans, or government bonds. Most days that system works. On panic days, it does not. This is called a liquidity problem. Liquidity is just how quickly something can become spendable cash. A house brick cannot buy bread by noon. A bank cannot instantly turn long loans into cash for every depositor at once during a panic. The system behaves like a theater with one narrow exit and 100 people who suddenly smell smoke. Governments step in because they fear the stampede more than the outrage. They shut banks and cap withdrawals. They block transfers and announce a bank holiday, which sounds festive but means the opposite. Capital controls are rules that trap money inside the banking system or inside the country. Sometimes they force losses on large depositors in what is called a bail-in to rescue the bank. A bail-in means the bank is rescued from the inside using creditors instead of taxpayer money. A frozen account is an emergency dam placed across a river that is already breaking its banks. The freeze is the state's admission that the cracks have spread too far to hide. Long before Argentina or Lebanon, Americans lived through their own nationwide moment of financial paralysis. Many remember the Great Depression as breadlines, but few remember the 1933 bank freeze. By the time FDR took office, the country had already endured a month-long run on banks. A bank run is fear feeding on itself, like a crowd pushing toward a door and creating a crush. There was no federal deposit insurance yet. If your bank failed, your savings could disappear for years. Families pulled cash, hid it in homes, and made the panic worse. FDR proclaimed a national bank holiday. All banks shut down. Checks stopped, credit froze, and normal life paused like a watch dropped in water. The United States called it stabilization. For people outside locked doors, the feeling was the same. On 9th of March, Congress passed the Emergency Banking Act. Banks in major cities began reopening sequentially. The sequence and message mattered. Roosevelt told Americans it was safer to keep money in banks. That line was policy, backed by emergency currency support and an implicit promise of no collapse. By the end of March, 2/3 of hoarded cash had been redeposited. The stock market rose significantly. The freeze worked because the state paired coercion with credibility, building a bridge back to trust. Some freezes are desperate attempts to buy time, while others are the final stage of breakdown. The locked door looks identical. The difference is what sits behind it, real support or just delay. By late 2001, Argentina looked stable on the surface, but was exhausted underneath. For a decade, the country lived under a peg that kept the peso 1-for-1 with the US dollar. For ordinary families, that peg felt like a promise written in stone and made deposits feel safe. A currency peg is like holding a heavy door shut with your own body. It works until strength fails. If your government closed every bank tonight, would you believe it would reopen safer in days? The real event is whether the country has a credible backstop behind the freeze. Argentina did not. Public debt rose from 35% of GDP in 1995 to nearly 65% in 2001. Investors demanded punishing interest rates. In 2001, the yield on 10-year bonds climbed to 35%. That is the market saying we no longer trust you. Depositors began withdrawing money. Officials tried to stop the bleeding with the corralito. The name means little corral, like a pen. Cash withdrawals were restricted to 250 pesos a week. Temporary is an expensive word in financial history. Rent and groceries require cash. Landlords do not care that debit cards still work on paper. People lined up at ATMs, smashed bank windows, and banged pots in the streets. A frozen account turns middle-class life into improvisation. The budget becomes a bucket with a hole. In late December, Argentina defaulted. In January 2002, it abandoned the currency peg. The peso collapsed, depreciating 356%. The economy contracted by 20% over 4 years. This was a state, currency, and trust problem braided together like 3 fatal wires. The money was not merely frozen, it was transformed. Dollar deposits were forced into pesos. Savers who thought they held hard currency discovered they really held a political claim. A bank balance feels like property. In a crisis, it can become policy. Even in 2019, many Argentines still preferred to keep savings at home because they remembered the freeze. Trust does not shatter and disappear. It lingers like smoke in the curtains for a generation. Cyprus in 2013 was inside the Eurozone, yet the script suddenly looked familiar when pressure peaked. Cypriot banks were enormous compared to the economy and exposed to Greek debt restructuring. In March 2013, officials announced a rescue plan that included a one-time tax on bank deposits. It proposed taking 6.75% from insured deposits and 9.9% from those above 100,000 euros. Authorities shut down electronic transfers immediately. ATMs were emptied by panicked depositors. Parliament rejected the first plan, but the fear was already loose in the country like dye. A 10-day bank holiday followed. That is a long time when payroll or tuition is due. A bank freeze squeezes the entire chain of life, from cafe owners to shipping firms. The economy becomes a body whose blood is trapped. When banks reopened, the new arrangement was harsher. Laiki Bank was wound down. Bank of Cyprus deposits over 100,000 euros were converted into equity. Money for retirement or trade was turned into a forced bet on a wounded bank. Capital controls followed. Cash withdrawals were capped at 300 euros per day per depositor. Even in an advanced monetary system, depositors learned that bank money is not the same as cash. Once a country crosses this line, everyone starts relearning the meaning of the word safe. A freeze reveals which claims the state can honor and which will be stretched or delayed. Cyprus did protect deposits under 100,000 euros, preventing a worse panic, but still hurting many. A balance above a threshold can be payroll, inventory, or the proceeds from a lifetime transaction. Account freezes turn abstract policy into kitchen table math and drain trust faster than expected. Most people will keep trusting systems they do not understand, but you're not most people. All these cases share the same mechanism. Confidence breaks and money starts to leave the system. Authorities realize everyone cannot exit at once without destroying the banking system entirely. They slow time by force. The government grabs the hour hand on the clock to decide losses. Freezes are rarely about protecting everyone. They're about deciding who must wait or pay. The law-abiding middle class is a clean target because its money is visible and documented. You can trap what is already inside the fence. Greece in 2015 looked like a dispute over terms. On the street, it looked like pensioners waiting in heat outside shuttered banks. Greek banks lost 27.5% of their deposits. It was a reservoir draining through a crack. Authorities declared a bank holiday and limited ATM withdrawals to 60 euros per day. 60 euros is arithmetic with sharp edges for a pensioner supporting 2 adult children. For a pharmacy or restaurant, a withdrawal cap is like trying to breathe through a straw. Solvent people look distressed because an economy runs on timing, not just balances. Lebanon's crisis in 2019 was a sudden stop in capital inflows, cutting oxygen from the room. Banks locked depositors out of dollar accounts and rationed access with ad hoc rules. Over $100 billion remained trapped. The currency lost around 90% of its value. Real GDP contracted sharply and poverty was projected to surpass half the population. Dana Trometer told Reuters her mother could not get a penny out of the bank for essentials. Desperate depositors stormed banks with toy guns to demand their own savings for survival. When a society reaches that point, the freeze becomes moral. Poorer savers are usually hit hardest. Connected people moved money out earlier while the people who followed the rules were trapped. When the gates close, the people nearest the exits are rarely the ones left outside. Modern speed doesn't remove fragility, it magnifies it. Fear travels at the speed of a screen tap. Historical freezes show where pressure lands when a system is forced into triage. Triage is deciding which payments clear and which withdrawals wait. It is a grim logic. The question is whether you will see the pattern before it sees you. Subscribe to think differently. Survivors shared 3 characteristics. First, they understood concentration risk before the panic arrived. If all your money sits in one domestic pipe, one policy move can freeze your whole world. Those who fared best had more than one pipe, spreading risk across currencies or institutions. Second, they paid attention to policy signals early. The final freeze sends warning flares for months. Rising yields and political paralysis are tremors in the beams. pay attention to early signs. Third, they valued access as much as nominal wealth. 1 million trapped units are useless. Survivors understood that optionality matters. A flexible balance sheet bends while a rigid one breaks. The schoolteacher in Buenos Aires did not cause the crisis, but she lost access in real life. Money in a bank is a claim on institutions and trust, hidden like steel inside concrete. Sometimes the state restores confidence, and sometimes the freeze is just a sorting machine for losses. The freeze is usually the last clear warning. The river changed course before you heard the water. This is educational analysis, not financial advice. Share this to change someone's world and subscribe.